medical research shows that it is the lack of sensitivity in insulin that causes most of the modern day illness. Similarly, in all the global market crashes, the cause is one and the same. It is lack of a globally traded collateral. When this trust in collateral goes down, the entire global market, irrespective of their asset class, will come crashing down. Learn more.
You ever just watch the markets and wonder how the entire global financial system can go from perfectly fine to the brink of collapse, seemingly overnight? It's not just about stock prices. It's about something much deeper, the hidden plumbing of money itself. So let's dive in and actually uncover the real mechanics behind a global crash. I mean, it seems impossible, right? How can one single solitary asset getting a bad rating cause a worldwide panic? A panic that sends every market from stocks to bonds into a complete nosedive. That's the big mystery we're going to solve today, and it all comes down to the system's core engine. The stage for our whole story is something called the Eurodollar system. Now, think of it as this massive offshore financial network where US dollars are basically created outside of the US. It's not run by a central bank or anything. It runs on just two things: trust, and most importantly, high-quality assets that are used as collateral. And that collateral, well, that's the key to everything. So, when times are good, this system is an absolutely incredible money-making machine. It creates all the liquidity that keeps global trade and finance humming along. But, and this is a big but, it's all built on a very clever, and as we'll see, a very fragile illusion. This secret sauce here is a process with a fancy name: rehypothecation. Now, this isn't some kind of fraud. It's the accepted, normal backbone of the system. It's simple, really. It just means taking a piece of collateral that someone gave you and then using it again to get a loan for yourself. Let's walk through how this works with a simple example. To really get this, we're going to follow the life of a fictional but very representative asset. We'll call it the Zeta bond, okay? It's got a AAA rating, it's worth a cool $1 million, and everybody in the world trusts that it's good, solid collateral. Okay, so here's the chain. First, Bank A pledges its Zeta bond to Bank B and gets a $1 million loan. Easy enough. Then, Bank B, not wanting that beautiful collateral to just sit there doing nothing, repledges that exact same Zeta bond to Bank C for another $1 million. And then, you guessed it, Bank C does it again. With each step, brand new money is being created. And this just shows you the results so clearly. We started with just one single $1 million Zeta bond. But through this magic of rehypothecation, the system created $3 million in claims, or, money. This is how the system creates massive, massive amounts of liquidity from a very limited supply of top-tier collateral. And it works perfectly, until it doesn't. So how does this incredible machine just break? Well, the whole system, the whole thing rests on one single assumption, that the Zeta bond is rock solid. So what happens when that assumption completely shatters? And then the shock hits. The news breaks. The stuff backing our trusted Zeta bond, it's worthless. It's junk. Confidence just evaporates instantly. The bond's value plummets from $1 million all the way down to just $450,000. And right here, this is the moment the math at the entire system completely breaks. Just look at this change in leverage. Before the shock, we had $3 million in claims on $1 million in collateral. That's 3x leverage. Manageable. But after, we still have those same $3 million in claims floating around, but now they're backed by less than $500,000 in actual collateral. The leverage explodes to almost 7x. You suddenly have over $2.5 million of money that's backed by, well, nothing. The really crucial thing to get here is that this is not some slow, orderly unwinding. No way. It's a sudden, chaotic, non-linear collapse. All those claims come due at the exact same time, and the system just instantly freezes solid. This mathematical break, it triggers an immediate and desperate scramble for cash. Every single bank in that chain gets a margin call at the exact same moment, demanding more collateral. But the collateral they were all using, it's suddenly toxic. And in a crisis like this, all the normal rules of finance just get thrown right out the window. Getting cash right now is way more important than getting a good price for what you're selling. Having liquidity is everything. The theoretical valuation of your assets means nothing. You sell what you can, not what you want to. So this leads to a really confusing question that people always have. If the Zeta bond was the problem, why do perfectly safe assets like government bonds start crashing too? Well, this is how the contagion goes global. It's because the Zeta bond is now totally unusable, right? So everyone needs a replacement for it, and they need it now. And in a global crisis, there's really only one universally accepted form of pristine collateral: US Treasury bonds. So you have everyone on the planet trying to sell whatever else they have to buy Treasuries, all at the exact same moment. This just overwhelms the market for even the safest asset in the world, causing it to become volatile and totally illiquid. Now, you might be thinking this whole Zeta bond story is just a neat little parable, but it's not a parable. It's a blueprint. This exact dynamic has happened again and again and again in the real world. This quote just captures it perfectly. The name of the bad collateral changes every time, but the underlying plumbing failure, that rehypothecation chain snapping, it is always, always the same movie. I mean, just look at this. In 2008, the Zeta bond was AAA rated mortgage-backed securities, which were built on, you guessed it, junk housing loans. In 2011, it was European government debt that people feared would default. And get this, in the 2020 COVID crash, the scramble for cash was so intense that even US Treasuries became the source of stress. It's the same movie, just with a different cast of assets each time. So, if you take one thing away from this whole explainer, let it be this. Global crashes aren't really about people panicking over stock valuations. They are plumbing crises. They happen when the collateral that underpins the entire global creation of money suddenly and violently stops being trusted. And that's really the final crucial point. The Zeta bond's failure didn't just cause a financial loss. It shattered the core belief that allowed the entire system to function, that illusion of infinite liquidity from finite collateral. And the question it leaves us with, the one we should all be asking, is what collateral are we all trusting today?